Good morning, everyone. First of all, thank you so much for coming here. It's great to see a full pack house. And my name is Bilal Jafar. I cover crypto and fintech for Dow Jones in London. And today we're having a really, really interesting topic to discuss the digital assets lifecycle. And nothing better than to have these prominent names with me on stage. Because the entire purpose of having these events is not only networking, but I do believe that we can discuss some of the most important topics going on in the industry and what the future might look like. So, without further ado, I would like to introduce my panel and starting with you, Jonathan, please.
Thanks. Yeah, so I'm Jonathan. I'm CMO and head of platform strategy at Swiat. Swiat is a joint venture formed by the banks Standard Chartered, LBBW, and Deca Bank. And our aim is to create a financial infrastructure from and for financial institutions.
Hi, I'm Nadia Filali. I'm head of innovation and development in Caisse des Dépôts. Caisse des Dépôts is a French public group and a French public bank. And we are working on the subject of blockchain and digital asset from many years now. We began to work on that in 2015, and we are also a custodian on digital asset for our public clients and working on the subject of tokenization of assets already and on the IDs.
Hi, I'm David Cunningham from Citi Bank. I lead our strategy and partnerships for digital assets across our payments business. So we move about $5 trillion a day in that business, and what we do is just explore all areas where blockchain and other technologies can help accelerate what we do to benefit our clients.
Good morning, all. Nice to be here. My name is Rajiv Bamra. I am the head of strategy and operations for DeFi and digital assets at Moody's. I and my team do is we try to identify operational risks and technology risks and evaluate how they would integrate with the known financial risks based on the methodologies and frameworks that exist today for the traditional finance ecosystem.
Hello everyone, I'm Barnaby Hodgkins. I lead strategy in EMEA at Blockdaemon. We're a blockchain infrastructure company. We run close to 100,000 nodes, but also provide staking infrastructure as well as wallet tech as well. We're backed by some of the largest financial institutions in the world, including Citi Bank and Goldman and JP Morgan.
Well, thank you very much for the introduction. We'll start with like the most important topic in the digital asset life cycle. How important is it for people to understand the segregation of these functions when we talk about issuance, when we talk about trading, settlement, and custody? How important is it for people to actually understand this each and every function? Starting with you, Jonathan, can you please shed some light on it?
Well, I think that question, if you look at this question, how important it is to segregate those roles, I guess you see when you look at it at a grand scale, and if you want to go into production, truly scale, you will realize that you still have these roles. You maybe have reassigned them in a certain way, right? Because responsibilities have been reshaped, redistributed, but they do not disappear, which is quite interesting. We have realized this in a lot of projects already now, and as well with a few things that we have brought into production as well. And what we have seen is there's still an issuer, there's still someone that is kind of running a registry. So for example, we have built in Germany a software that is regulatory compliant for the issuance of bonds, of electronic bonds. And there you again have a registrar, kind of like an entity that is responsible for ensuring that you always know who's the real owner of the asset, yet you still have a custodian. Right? So the entire setup is getting more efficient and scalable. However, the roles are still there, so the responsibility is just redistributed. That's our main take on that one, I would say.
Nadia, would you like to shed some light?
I think what I can add is here it's important to have distinction between the function, if you're an issuer, a custodian, or an asset manager is not the same, and it's true in the trade finance, but I think it needs to be true here with the digital assets, because one of the points that is important is that you need to secure your clients. The client could be a retailer or institutional, and there is something about trust and confidence. If you don't secure the function on the clients, and someone will work on all the life cycle, it could be sometimes a little tricky, and sometimes you can have a lack of confidence on these intermediaries, because you don't know where they put their interests, and there is some financial risks also that you need to manage. And so for me, it's normal, and it's important that we can separate the function, even in the world of digital assets. After that, it could be a little like a paradox to say that, because digital assets and blockchain make you, or DLTs, what you want, but make all the process really useful, and you don't need to have you can do all the process in the same way. You don't have to cut the things. So how you manage that in a fluent process could be difficult, but it's a question. But I think it's important.
Thank you. David, I would like to have the institutional side explaining all these different functions.
When I'm speaking here with one of my colleagues that I work with closely here from compliance, I'm always thinking, what can I say? Where are my guardrails and that? So this is what goes inside my head. But I think it's important to distinguish that what's happening in traditional financial services and what's happening today. Just for an example, in this room, who here is involved in crypto or digital asset issuance, trading, settlement, or custody, let's say in regular crypto? Like, let's say in the audience, how many people does one of those things with crypto? So lots of people. There's lots more out at the stands there talking about doing that. So doing this thing with regular public blockchain infrastructure is actually quite easy. Most of you could probably help me to do this in an afternoon. What we've seen is doing this in really large regulated financial markets is difficult. So, even for ourselves, for us to tokenize $1, let's say, as we've done with what we call Citi Token Services that we launched recently, that takes a long time and lots of conversations in order to do that. And that allows us to move money 24/7 between a couple of branches, remove cutoff hours, and do interesting thing around payments. We're doing a lot of things in the digital assets in terms of tokenized bonds and securities as well. But to do this in a regulated environment takes a lot longer than an afternoon. So what I've seen really is, which is good news for everybody who has expertise here, is that we're truly seeing large organizations do things at a scale which we haven't seen before using this technology, and those who have skills to help empower regular financial market infrastructure and regular players like globally systematically important banks like ourselves to operate in this space. We need your skills and we need your help, and I think we're going to see a massive adoption in the next number of years, where this really grows in the regulated space too, which is really exciting. But I think the key thing about all of this is that every element of doing this in a regulated environment takes some time and takes some effort and takes some coordination and takes a lot of work in terms of standards and standard setting as well. So, for me, I'm really excited to see how this tech is going to really massively scale over the next few years into many trillions of volume and scale on a daily basis.
Rajiv?
Yes, I second everything David said. I come from a traditional financial institution as well. And he mentioned compliance. Moody's is all about compliance and risk management. So totally echo everything that David said here. However, I think one thing that may be missing from an education awareness perspective is the understanding of how the process in a traditional world of, let's say, for example, an issuance of security would look in the DeFi or a digital finance ecosystem, explaining what would sit on chain, what would sit off chain, which pieces would disappear or the intermediate or disintermediated, and that is something that needs to be done by someone at a large scale, maybe a regulator as part of their guidance. Um, um, and the second piece, I think segregation is important because it does allow companies like us to manage risks and also follow compliance from the regulations perspective. And all it would do is bring in operational complexities, but at the same time, the benefits of a well-organized digital finance ecosystem would outweigh these complexities and risks that putting the workflow in place and segregated roles and responsibilities would bring to the table.
Yeah, Barnes?
Yeah, I very much agree with what Rajiv just said there about the importance of segregation. Like, I think we only need to look as far back as FTX and what happened there. And I think the days of these sort of behemoth centralized exchanges where you park your digital assets, you trade your digital assets settle on chain, and in some instances, that firm even issues their own digital asset that then trades. I think they're fully, or they're gone, or that they will go. Certainly not bullish on that. And obviously the segregation of these roles needs to take place and increasingly is happening. And I think you see the rise of sort of regulated custodians in digital asset space as evidence of that. That being said, I don't necessarily think it is as simple as just like, oh, look what's happened in digital assets. We need to just take that market structure from traditional finance and put it in digital assets. So like, to take an example, for example, I used to sell fixed income in my old career, and let's say you issue a bond in traditional finance, it then might get issued by a number of issuing banks. It then falls onto the trading desk. The trading desk might sell it to an asset manager, but the asset manager will have to be linked up to a clearing house if it's an EGB, say Euroclear. Going forward, there's probably, in terms of the segregation of things, there will still be need for someone to issue that digital bond, but the extent to which, say, a Citi Bank could sell a digital bond directly into the wallet of we just saw Christoph, like a Union Investment or a DWS, I think that could potentially happen. So I think a lot of lessons to learn from TradFi in terms of segregation, but also a lot of areas of improvement and potential disintermediation.
If I'm allowed to jump in, because I really love what Rajiv and David said about the compliance aspect of things, because as soon as you move outside of doing a proof of concept and doing a POC and going into true scale production, right? So when compliance does not say, okay, you're allowed to do 3 or 5 trades, but okay, I'm not going to look at it again because it's checked, right? That's basically the moment where you have talked to your tech guys and says, well, you maybe redesigned it. We mixed some relationships and responsibilities. It's just what we can do, but is it what we should do? Right? And exactly in that moment, you realize, okay, having a clear set of distributed responsibilities makes sense. I would not necessarily call it segregation, because I think there's a lot of relationship going on between those roles as well. But it's important that, in particular for regulated entities, that distributed cannot mean I'm not responsible if something goes south. And that's the grand issue, I would say, and as well where then the blockchain technology itself comes in. For example, I remember last year being as well at the EBC, and we were talking about the Terra Luna coin, where just suddenly the blockchain stopped, right? Because some people were making losses, and the validator said, "Oh, well, that's not convenient for us, so let's just stop validating." Right? So that's a new relationship as well that is coming in. So we need a clear set of distributed responsibilities to truly scale, and only then we will be compliant with the regulators, right? And that the only way how we can see that this is achievable is via permissioned infrastructures.
So since David is in the firing line, I think we should ask him more questions. So, David, how has the digital asset lifecycle ecosystem changed since institutions came? The kind of discussion that you used to have a couple of years ago, how those discussions have changed now when we talk about the digital asset lifecycle. I'm asking from an institutional perspective, and then I'll move to Rajiv about it.
Yeah, well, I think it's probably important to figure out where people are trying to go. Like, why are we doing this? Why is anybody interested in blockchain, let's say? So if we take digital assets, what currently happens, let's say in securities is, our security services team, want to enable our clients to buy a particular asset. So the order has to go through. Then, when the payment comes along, there's a Swift message which sends the data, and then the payment goes on a different rail. And let's say for us, we're like we are the largest shareholder in Swift, for example, but then we still have to use and maintain 280 clearing systems globally. It's a complicated thing. Along comes Ethereum, and you get the data, which would be Swift's role. You get the asset and the payment all on one ledger, and you get atomic settlement there of all of these things. I think that's where the industry would love to get to, because it, in the area of risk, it reduces risk if you can get paid straight away, or you can enable people to get them into their hands. So what we've seen is, what might seem a slow progression in terms of solving parts of that puzzle. So, the tokenized securities, the tokenized funds, that's starting to come in in a large scale in the regulated world, or sorry, in the TradFi world, let's say. The payments being able to move 24/7 with instruments that are actually okay with our regulators, that's starting to come too, because you could say, why doesn't everybody use stable coins, or why doesn't everybody use crypto just to do this thing? Our regulators aren't big fans / won't allow you to use a public chain for payment, for example, because you don't know if the gas fees are going to a sanctioned entity or a sanctioned country or whatever. Governments also prefer to have sovereignty and control over their currency. They prefer sovereign currencies. So what we're seeing now is obviously CBDCs coming to life, but we're seeing tokenized bank deposits and liabilities, let's say, which are sovereign money on a blockchain that gives the benefits of 24/7, but is with a legal instrument that countries and governments are very comfortable with. So we're starting to see great comfort coming, and real things coming to life at scale in the security space, in tokenized securities, in tokenized cash, and regulators being comfortable with it. So it's been a journey, but right now I feel it's just at the edge where it's going to really. There's so many large organizations in the regulated space working on this. So for ourselves, we collaborate with a bunch of other banks, with MasterCard, with Swift, with the regulator, to experiment in things like the regulated liability network. So it's just at that tipping point where it's gone from not much of a cycle because there wasn't much happening to a lot happening quite quickly is my current view as to where things are at.
And David, from tokenization perspective, what are your plans going forward? Expansion plan? How would you like to expand your services within that ecosystem of tokenization?
Well, I think for Citi ourselves, what we've done is we just launched, as I said, Citi Token Services, which enables cash movement for our clients between two branches, just to start with, New York and Singapore. Just with pilot clients at the moment, so it's not fully live and rolled out to everybody. But essentially, it's a move in a direction that sees us enable people to remove cutoff hours, to remove money trapped over weekends, let's say, in certain areas. So it allows for that truly 24/7 money. And then we also launched Citi Token Services for Trade, which tokenizes things like letters of credit to take them into a smart contract. So you're seeing, so for us, this is brings a 24/7 process that sits on top of 24/7 money, which is really exciting. And we'll be expanding that. I'm not going to go into the details now, but the goal is that this is quite widespread throughout ourselves. But if I can step away from our immediate roadmap, what you're seeing from large institutions is you're seeing huge benefits from this technology in systemizing paper-based, human-in-the-loop, fraud-prone, error-prone processes like bills of exchange, bid guarantees, standby letters of credit. All of these things blockchain is going to really make a huge impact in. But once you've digitized those paper-based, human-in-the-loop processes, if you don't have money that moves 24/7, you've got a big problem. So that's where the industry is moving to, the money being 24/7 and the instruments used being 24/7. That's where I see it going.
Thank you. Rajiv, your views, institutions impacting the digital asset life cycle?
Yeah, no. So David actually covered everything. So 24/7 access for sure. Time to market or speed to market, operational efficiency, cost, asset diversification, as well as risk diversification on our end. But I would just like to turn that a little bit and speak from the digital finance perspective. We've seen the market value of digital finance drop in the past year or so, or 18 months or so, by about 60-70%. This is due to the investors trying to move their assets or their investment from a more risk-seeking to a risk-averse portfolios in the traditional finance space, with all the interest rates going up and better portfolios being available and more risk-averse portfolios being available in the ecosystem. This is in a way trying to also showcase that more and more DeFi protocols in the past few months have tried to integrate with the real world economy, and thereby also working with the institutions to expand their own asset and product diversification, which also, as I said, diversify the risks. So if a traditional institute were to tokenize a pool of loans on a blockchain platform, they can open it up to the investors in a DeFi protocol, thereby also sharing the credit and counterparty risks by the investors in both ecosystems and vice versa. So this also kind of helps institutions to use the technology and the efficiencies that technologies bring, as well as increasing the range of products they can offer by integrating with digital finance ecosystem.
Thank you. Jonathan, you.
Yeah, just to elaborate on, and add maybe as well to the discussion on how institutionals are now shaping this adoption, right, and how the space has changed. Last week I had a very funny conversation with a fella from the, well, I would say pure Bitcoin fan base, right? And he was asking, well, Jonathan, I read that in the savings banks group you are now already issuing bonds to each other to refinance the individual institution, right? That's such a boring asset. Why do you do that? And I'm like, yeah, well, because it is so boring, we see that we can actually achieve mass adoption, right? Because it's so simple and plain. I want to be financed, I issue a bond, and this process is so much more resilient than paper-based. So that's what we see, for example, by LBBW, by Standard Chartered, by DECA, by the diverse set of savings banks that are onboarding already and have executed trades. It's like we are at the point where institutionals understand the difference between cryptocurrencies, crypto assets, and having traditional assets on chain. So and having them naturally issued, so natural digital assets, you could say, natural digital bonds, for example. And so this learning process and this understanding process has gone so far that I'm quite confident that we probably next year will be more talking about which platforms are now in the lead in the regulated space, because the institutionals are adopting so fast.
Thank you. Nadia, your thought?
Yes, and I agree with all what said before, but me, I'm working for a very, very old institution, okay, more than 200 years. And so it's difficult to explain to people that you will change something that it's work already. So you need to explain the benefit, and the 24/7 is one of the benefit, but it's not sufficient. And as you said, there is a question of regulation. And if you can explain to institutional that you can work on new things that will help them. For example, you have a lot of now of regulation of ESG reporting and ESG data, and it's growing up, I think, a lot, and it will grow again. And it's an issue for the issuer, it's an issue for the asset manager, it's the issue for the risk entity, it's the issue for the compliance. And if you use the technology to help them to work on that, and especially, for example, you can work on the smart contract and provide all the information that you need for the green finance, it could help, for example. And it will be more easy to onboard them. I think it's something really very important. And I'm not sure that for the moment, and I agree with the distinction that they will work more and on the currencies, because it's something a little tricky, and with something that there is an area here of risk really important. But if they work on securities in the beginning, like a traditional asset that we digitalize, it's something could be good in a first way. And working on crypto assets for institutional, I think it will be very thin in the beginning, because it's the same. There is some regulation, and for example, in what happened on the guarantee that are demanding for Basel III, for example. For Basel, it's very huge and complicated for the institutional.
Thank you. Barnes, please.
Yeah, I think it's almost, from my perspective, the only thing I would add is, and it might almost seem counterintuitive given the levels of volume that institutions are bringing, or call it traditional finance institutions are bringing to the party at the minute. But I do think going forward, what they will bring is huge amounts of volume and liquidity that, genuinely speaking, like it isn't there, or certainly relatively speaking to traditional finance isn't there. So to give an example, I used to sell a fixed income repo, and we would do billions a day, and so you're starting to see banks like Citi, Goldman, JP tokenize the cash, tokenize the money market funds or the bonds, and do that repo instead of the cash or the bond settling the following day. It settles instantaneously, so that money can go and be used around their global operations. And the same can be said for the examples that David gave around the 24/7 movement of cash. So I think once they are rubber stamped by compliance internally at those sorts of institutions, the genuine volumes you could see could very much be like a hockey stick. And so I think the native cryptocurrency market is obviously, there's been the rally over the last few days, but sort of hovering around 1 trillion. I think you'll quickly see the market cap of, say, tokenized securities, tokenized cash, surpass that pretty quickly over the sort of next 3, 4, 5 years.
And when we talk about traditional finance, my next question is that how different or similar the process is when we talk about the issuance, trading, settlement, and custody of digital assets compared with the traditional assets like equities. What sort of differences and similarities are there? Starting with you, Nadia.
Oh, differences. I think there is one difference, that you are not using the same technology. First of all, it's really concentrated, because if you are using Swift is a standard for everyone. Now, if you are looking digital assets, you can use different protocols. So there is different standards, but there is no. Even if some are using more what is based on Ethereum or Polygon on others, but it's something really different to unify the standards and said we will use only one protocol. I think the war is not finished here. So and there is a commercial war, so it's something difficult. And for example, for the settlement, for the moment, if you are not using true money, you can do the settlement with a stable coin or commercial digital bank, but you are not allowed to go on the end and the finality of the settlement if you don't use fiat money for the moment. So there is here something that it's complicated and a little different. And on the custody, and as a custodian on digital asset and custodian on traditional asset, financial asset. When we launched the offer on the custody, we work with the same entities, the compliance, the risk, blah, blah, blah. And there is really a difference because today it's a little tricky to do your KYC there, to know where are the assets, where they are going. There is a difference because all the process on custody, it's less STP than in a classical way. And it's difficult to manage the key. And you are not a custodian on the asset. Concretely, you are a custodian on the key. And when Jonathan was talking about responsibility here, there is a responsibility, and we could have a lack of understanding if we don't know really where is the responsibility, who is managing that. And this point, it's little different, I think, than in a classical way.
Yeah, David, please. I'm asking this
Yeah.
because there are some traditional financial firms, including banks, who are still not in the digital asset space. So for them to understand the similarities or differences, they'll be in a better position to get into this ecosystem. So yeah, could you
Yeah.
please highlight?
I think the journey is important. I mean, look, until a year and a half ago, I was CEO of different fintech startups, regtech, some businesses using multi-party computation. I know what it's like to be starting as an entrepreneur with the idea that anything is possible. And that's a good place to be for experimentation. I think so if you're in an unregulated area, anything is possible to a degree, and you start with that premise. In a regulated institution, you need to start with the idea that nothing is possible unless you have expressed permission for it even to be remotely possible. So you got to work with the larger organizations to say, I know it's a no-brainer to digitize paper-based old instruments that have been used for years. Like, we do something like 40 million letters of credit a year. Like, that's billions and billions of pieces of paper and humans in the loop. It makes total sense to do this, right? But you got to work in stages to get permission for everything. And it's very much a ask for permission rather than an ask for forgiveness type scenario. So I think it's just important for those of us who are used to, being in that entrepreneurial world where anything is possible, to just, when you're trying to move to traditional finance and to regulated kind of areas, to get into the trillions. So for us at Citi, we pushed a report there in March that talked about 13 trillion worth of digital assets by 2030. It is going to be huge. And then you've got the global payments. We just published a report saying that's a $250 trillion prize there. So the prize is large for all of us who have the patience to work and kind of get permission to push things on and to help move in a regulated manner, because we'll be working in just a much bigger pie rather than, as Barnaby quite rightly said. So what I would say is, just for those of us that are here who are interested in advancing the use of this technology, be patient and try and see how far you can go and help change those standards. And let's work together to try and push the standards, because the more our regulators get comfortable with this, then the better for everyone.
Rajiv, please.
Yeah, I mean, everything that David and Nadia just said, I would echo that. But I think it's important to identify the use case, and blockchain is not a solution for everything. I think some use cases are just being put on blockchain. Why not? But we need to identify the right use cases, have the right assets in mind before even we tokenize it, and find the need for the kind of efficiency it would bring if blockchain is used for that particular asset. So that's one thing. But the difference between the two ecosystems is, we've mentioned this before, 24/7 availability and accessibility, a huge difference. I think traditional institutions are going to use that as much as possible by introducing new products. But at the same time, with digital finance ecosystem being integrated into traditional finance, there is also more market maturity that needs in the digital finance ecosystem, which exists only in the traditional finance. And the kind of products you can issue in the existing regulatory framework can only happen on the traditional finance side and not on the digital finance side yet. So we already spoke about the benefits of the digital finance ecosystem, but I think there are benefits on the traditional side which the digital finance ecosystem can make use of and learn from, and probably the integration will help both sides in the long run.
Bond?
Yeah, the only thing I would add is I think it's good. I think the custody space and the difference between those two spaces is super interesting, and I'm personally very interested to see how that one plays out. Like, the difference between the two at the minute is one is highly regulated and one is like not regulated whatsoever on the digital asset space. So if you're a traditional custodian, for every $1 you custody, you have to either be insured for that $1 or you need to hold that $1 on your balance sheet. Those rules will come to digital assets through MiCA, and I think the United States is still figuring it out. But when they come, it'll be very interesting to see who sinks and who floats and what firms come out on top, because a lot of digital asset custodians are currently working to a runway, as are a lot of people in the digital asset space. So they certainly don't have capital on balance sheet, and the insurance market for digital assets isn't necessarily mature enough right now to insure these digital asset custodians. So I think that's an interesting space, like the way custody of digital assets, custody of tokenized securities pans out, and depending on how much those native digital asset custodians mature in the next sort of half a decade, could play into like who necessarily gets that prize that David alluded to.
Jonathan? Well, connecting to the aspect of key differences, right? I thought there's one major key difference that I think we haven't discussed yet, is actually the conscious choice of the infrastructure that I'm going to use. I mean, we briefly touched upon this in this panel, but the difference between now and then was that I mean, traditional finance, for example, of course, I can move that on the blockchain, and we have all the benefits that Rajesh mentioned. And I would say it's instantaneously, right? Instantaneously, I think that was missing in that list. But of course, I can as well get a few new use cases, even though we must agree or must say a true product market fit in an institutional grade we haven't seen yet from these new cases, right? There's always this element of speculation in it. So I think the most probable case is that TradFi will be moving onto the blockchain and scaling there. And there the key difference is now that the regulator is making suggestions on how to treat this from a capital treatment perspective for banks. So if we look at Bank of International Settlement, we have seen a paper that has been consulted already twice, and it's now in the last phase of consultation on the prudential treatment of capital asset exposure. And with capital asset, they mean actually all assets on crypto environments, so all blockchains. And they say, well, if you do not want to have additional capital treatment on those assets, you must as well evaluate which blockchain infrastructure you're using. Because, and I guess that's something for Moody's to evaluate then in the future, is how does it comply with outsourcing questions, right? How is the material risk being managed? What if a validator just stops working, right? So the current perspective that the regulator from that point of view is taking is that unpermissioned is not suitable for a scaled in production grade for institutions. And I think that is not a trivial choice, and actually must be considered as well by the business units. Which infrastructure do I want to use, and do not leave it with the techies, right? We have seen that in the past it has been left with the techies because they can build better things on that environment or better things on that environment. But coming back to the compliance part, the question is, well, should I do it, right? And I think that's the key aspect on that.
If I can just add a point. So, digital finance ecosystem brings in makes everything cheaper, faster, and more efficient. Cheaper, the ROIs will be seen in a few years' time. The cost efficiency won't be seen in the near future, but it will take a while to show. From a risk assessment perspective and coming back to compliance, digital finance ecosystem also adds a layer of technology and operational risks when it comes to credit assessment that we do at Moody's. And that's also the work that we do, where we have to look at the platform risks, what protocol you're using, does it have business continuity planning? So someone mentioned Terra Luna earlier and how the blockchain just went down. I mean, that's a problem if you're assessing the credit risk, for example. Smart contract risks are the new form of risks and the most important ones, along with how the assets are being represented on chain. So I think those are the risks that also need to be looked into when you talk about digital finance ecosystem.
It's basically the risk you get by using a decentralized setup or a distributed setup, because you get others involved in your operations, right? And this risk has to be evaluated somehow. And we see that now the regulator is catching up and saying, well, these are the following penalties if you're in the wrong setup.
Perfect. Thank you so much, everyone. That was it. It was really, really nice talking to you, and hopefully we will be able to see a more improved version of digital asset lifecycle in the future.
Could I add one more thing? I think just what I think we need to look at is what future we see. Do we see a digital asset network and then a TradFi network, or do we see the two interacting? You know, and I think regulators and lawmakers struggle with one that's totally blockchain and having to regulate that and something else. And I think for us, what we're doing here today, which this conversation has been a great part of, is trying to figure out how do we upgrade the financial market infrastructure globally to take the benefits of blockchain to upgrade the existing one, because I'm not sure that there will be two. But I'd love your thoughts on that. I don't know. I think we've got 50 seconds or so, but I think that's my view, is that, like, if we can work together to upgrade the existing, I think that will be a huge pie for all of us to work in.
Yeah, I think if you can find a... I'm sorry.
Sorry, I agree, because it will never be two, because if there is two, there is one that will die, because there is no market here, and we are always running on the market and the benefit on the market. And the point of the regulator is not a point of regulating a technology, but regulating a market. And I think we don't need to opposite that. And if the digital asset market and the blockchain market could show that it's possible to have this TradFi on those infrastructure, and there is benefits, it will work. But if we cannot show that there is benefit, it will not work, I think, already.
Great job on moderating the panel, by the way.
Thank you very much, David. Thank you, everyone. Thank you.